comprehensive and in-depth review. To
In his era, George brought the intellectual rigor of an academic to the practical, constrained, messy work of policymaking. Through 4 cabinet appointments, he dealt with many of the great issues of his day with remarkable success. And he kept at it long after leaving public office, making important contributions here at Hoover on healthcare reform, climate change, nuclear disarmament, and other areas. He may be less well known for this, but George Schultz was deeply concerned about racial discrimination in the workplace and in our society more broadly. He consistently and effectively used his positions of authority to increase opportunities for minorities. And he later noted that there was both a moral and an economic case for this. He stuck to his principles while also treating people with honesty and respect, including those with whom he had policy disagreements. Labor leaders welcomed his appointment as Secretary of Labor, and as many of his contemporaries remarked, faced with divergent views and difficult issues, he was extraordinarily good at steering people toward agreement. A key part of that strategy was to let the parties reach the final agreement themselves. That way, they owned the agreement and were more likely to honor it. His friendships and collaborations were beyond number and knew no partisan bounds. He often said that trust is the coin of the realm and that good things were only possible where there was mutual trust. His integrity provided the basis for that trust. All of those who aspire to serve the public can learn from his example.
Thank you. George Schultz's professional training, labor economics. Mr. Schultz earned his doctorate from MIT in 1949, taught at MIT for 9 years, then moved to the University of Chicago where he served for 11 years, 6 years as Dean of the Business School. Jay, labor economics, the importance of labor in the last century. Help us reconstruct that intellectual world.
So it was such a different world. Private sector unionization today in the United States is under 6%. In those days, it was around 30%. And collective bargaining for the major manufacturing unions in steel and autos and things like that, that was front page news everywhere. The job of the Secretary of Labor in any administration was to know the labor movement, know the leaders, and understand what they wanted. It was a very, very different time. And of course, George Schultz had studied collective bargaining. That was one of his main topics in his work as a labor economist, and he was extraordinarily well qualified to face the challenges of a labor secretary, and indeed went to Los Angeles to talk to President-elect Nixon, just to make sure that President-elect Nixon knew what George's views were on labor economics.
And he's a labor economist. This is the middle of the last century, when there's a great debate about labor taking place in the world. The communists had a certain view about labor. Workers of the world unite. This is Mr. Schultz. I'm quoting an interview he gave when he was here at Hoover, looking back over his career. The Chicago School stood for the fundamental value of freedom and free markets, close quote. Mike Condi, how did he integrate this belief in free markets into labor economics?
Well, let me start by saying that when I was asked to be Secretary of State by President Bush, actually the only person I called to ask about the job was George Schultz. And I said, so George, what do you think? He said, well, it's the best job in government. And I said, well, George, you should know because you've held almost every other job in government. But the reason that he said that is perhaps part of the answer to your question, Peter. He said that he always fundamentally believed that the United States had the right foundational principles, and that was much of the reason for our success. One of those foundational principles was, of course, the free market. And of course, the Chicago School, spread particularly in Latin America and other places, had, he thought, the chance to bring other countries out of poverty, to use their resources best, and to gain prosperity. But he also believed in the inextricable link between free markets and individual liberty. And that reflected in the way that he took on the challenge, of course, being the Secretary of State as the Soviet Union was beginning to go into its twilight. We forget that George's first years as secretary, the Soviet Union was a bit on the march. There's 1982, 83, 84. The sense that the Soviet Union was really the future. And from George's point of view, this was nonsense. And this is something that he shared, of course, with Ronald Reagan. That this experiment, as Reagan had called it, this experiment that was practiced on a hapless people would end up on the ash heap of history. Now, George, who was a great diplomat, would never have said it so boldly as Reagan did. But because they believed in the fundamental principles of the free market and individual liberty, the Soviet Union was on the wrong side of history. And they were, together, perfectly willing to say that, perfectly willing to challenge the system. There's a story that Mike likes to tell of George meeting with Gorbachev and saying to Gorbachev, you know, that central planning thing that you've got going, maybe you'd better take off with planning because you all aren't doing it very well. And can you imagine Gorbachev at that point thinking, who is this guy and why is he telling me about my own economy? But because he had been a great economist, because he'd been Secretary of the Treasury, I think George was able to bring this knowledge of how the free market worked, along with his belief in the free market and his belief in individual liberty, to really challenge many of the assumptions about the strength of the Soviet Union at that particular point in time, and then to be there, of course, for the beginning of the end.
Mike, a question for you on the longshoreman strike. Let me set it up. The Nixon years, just after George becomes Secretary of Labor under President Nixon in January '69, he finds himself confronted with the longshoreman strike. He's under intense pressure for the government to intervene, but he insists on keeping the federal government out of it, forcing the longshoremen and management to the bargaining table on their own. Instead of damaging the entire economy, the strike settles just a month after George Shultz takes office. Why was that such an important episode?
First of all, it set a really important example. Number one, that government intervention sometimes can be an obstacle rather than a provider of successful outcomes. Number two, it's really important because it signaled that people could make their own decisions and would be forced to if they were confronting each other rather than wait around for the government to come in. They wouldn't make their best offers, they wouldn't get serious. This became very clear to me. I was a beneficiary of George's advice and friendship, and we did a lot of things together over the years. Maybe talk about that a bit later, but it becomes really apparent when you're dealing with a whole different context than people that aren't used to thinking about markets, people that aren't used to thinking about individual incentives, people being able to think that way. And that goes back to your and Jay's comments and Condi's about his being an economist. He was used to this idea that people were trying to do the best they can themselves given their environment, and that if you let them do that, that would collectively lead to the best possible outcome. Kind of a basic theorem of basic economics, which some people forget, and there's always a pressure for the government to do something. If you know, all of us have been, Jay still is, but we've been in public office, and the first thing every morning in the briefing room is what's the president going to do about X? And it could be anything. It could be anything the president shouldn't have any worry about, shouldn't even know about. But so it's important to set that example and to let things play out until there really is something that you desperately need the government to intervene for, if that happens.
Two incidents in the Nixon years that are less, strictly speaking, economic than social. The Philadelphia Plan. In the spring of 1969, George Shultz issues the Philadelphia Plan, which requires federal contractors to hire minority workers, and he famously makes the remark that he's not imposing quotas, he's ending a quota, and the quota that he was ending was on black workers, and it was 0. As Secretary of Labor, he also ran the White House Cabinet Committee on Education, which was charged with developing a strategy for the peaceful integration of schools in the 7 states of the Deep South. He ended up running it because Vice President Spiro Agnew wanted nothing to do with it. He was given the chairmanship and never turned up for any meetings. There's a famous moment, I heard Mr. Schultz himself tell this story. George Shultz has the chairs of the Mississippi Committee come in. It's a white man and a black man, and he has them sit down together in the White House. And as they get close to an agreement, Secretary of State leaves the room. And I'm quoting George Shultz here. I learned long ago, you mentioned this in your remarks, Jay. I learned long ago that when parties get this close to an agreement, it's best to let them complete their deal on their own. That way the agreement belongs to them, close quote. By the end of the Nixon administration, this is a statistic I found staggering, I wasn't aware of it, more than 90% of black children in the South were attending integrated schools. All right, he's a labor economist, but in the Philadelphia Plan and in the integration of schools in the South, he's solving social problems. What's going on here? This has something to do with his own principles, with the respect in which everyone holds him. Jay, would you like to address these episodes?
I would. So this is something that people need to know more about George Shultz. This is an extraordinary accomplishment, and it is consistent through his career. He started the first minority program to bring kids into the University of Chicago Business School and many other things along the way. But in this case, Brown v. Board is decided in 1954. This is 15 years later, and there are 7 southern states that have just not desegregated their schools. The Supreme Court makes it clear that the argument is over and we're going to do this. George Shultz he takes over this commission, and he picks a black person and a white person from each of the 7 states. He gets them together, and they figure out how to do this because they now know this is going to happen, and he gets them to realize that, and the whole idea is this has got to be done without violence, and he manages to get that done. It's an extraordinary accomplishment. How did he do it? This is the sort of the full Schultz playbook of bringing people together, treating them with respect, empowering them, enabling them to take on this terrible, difficult issue, and it really worked. I mean, the schools did open without violence in these 7 southern states, and it's quite a remarkable story, and he really made it happen. So quite extraordinary.
Well, actually, I lived it.
Yeah.
Because I was a kid in elementary school in Birmingham, Alabama, in the early 1960s. And Brown versus Board of Education 54, essentially nothing happens in integration of the schools, despite the striking down of separate but equal.
They just ignored it.
They just ignored it, just ignored it. And then finally, after the Supreme Court, so they came up with this plan called, just before George's intervention, called choice. Now, choice is a good thing these days. In those days, it wasn't a particularly good choice good idea, because the idea was probably white parents would choose to keep their kids in white schools, and black parents would choose to send their kids to white schools. As it turns out, nobody chose to do anything. And this is actually kind of a funny story, a few poor teachers were sent to integrate the faculties of these schools. And my mother was one who was going to be sent to a white school.
Really?
Yes. My father was terrified because he was worried about the potential violence. As it turns out, my mother didn't go, but they sent this poor white woman to our school at Druid High School. And I felt so bad for her because everybody just treated her really, really badly. You know, she was the only one. So this was going pretty imperfectly. And I think one reason that I told this story to George, and I think one reason it was important to get people together and then get a plan for how to do this, which is what the Philadelphia plan really was because it was going nowhere, and to the degree that it was going anywhere, it wasn't going in a very good direction. And so George and I would kind of laugh about my own personal experience in what was going on in the South before the Philadelphia plan.
You know, it's worth mentioning that affirmative action has gotten a bad name of late, and California voters have rejected it twice, and perhaps it went overboard a bit. But back then, in the Philadelphia building trades, there was a quota of 0 African Americans. And so economists hate quotas. And a quota of 0 is a bad quota, just like a quota of a large amount. Okay, so I think it reflects back on his thinking as an economist. And as Jay said, there was obviously a moral as well as an economic justification.
Well, I think he felt the moral side very strongly because both in the Philadelphia plan and in the work with the school system, because again, it went back to George's view that America was the hope of the world. America was the place that had gotten mostly right, but there were times when America had not gotten it right, and on this, we had not.
Back to economics in the Nixon administration, and here I'm going to ask the three of you just to give me a seminar. We've got the closing of the gold window, and we've got wage and price controls. So I'll set up with what I know, which is very little. In 1970, Mr. Schultz becomes director of OMB. He's one of a circle of advisors, including Secretary of Treasury John Connally and Undersecretary of the Treasury Paul Volcker, who advised President Nixon to end the convertibility of the dollar into gold. President Nixon closes the gold window on August 15th, 1971. I'm going to quote Milton Friedman, his observation on this, quote, "The closing of the gold window opened the way to a free market for the dollar where there was none before," close quote. Again, we're dealing with something here so foreign to the way we do business and think about the currencies today that it requires a little bit of effort simply to take us back to the moment when the dollar was pegged to gold and what the debate concerned, why it was important. Who would like to take on? Mike,
I guess I'll start. So if we go back to the end of World War II and what George and Condi like to call the Global Economic and Security Commons was established, the International Monetary Fund, the General Agreement on Tariffs and Trade, and the World Bank were established. And we established the dollar as the centerpiece of the exchange rate system. Most countries would have fixed exchange rates, and the US would peg the dollar, exchange dollars for $35 per ounce of gold, and it pledged to do that for the foreign reserves, dollar reserves of foreign countries. So this again was George in the international arena as well, because it affected other countries. Now,
that enabled us to backstop economic growth across much of the world. Is that the idea?
It's a little more complicated than that. And I don't want to bore people in the audience with this. But what it meant was you could not have other countries and could not have an independent monetary policy along with the fixed exchange rates and free capital flows. Because if their interest rates were lower than ours, capital would flow out. They'd be pressured to devalue their currencies, and the opposite if their interest rates were higher than ours. So it created quite a conundrum, and we've seen that in more recent years when countries that had pegged their currency to the dollar ended that, and we've seen what happens. It was a little chaotic. So this, I think, was a major move. There had been a big intellectual debate for decades in economics about whether fixed or flexible exchange rates were better, and I think the flexible, market-oriented approach wound up winning, I think, to the world's advantage. So that was part one. Part two was because of this sudden change, and the dollar, we weren't going to exchange $35 for an ounce of gold anymore. Foreign holders of U.S. dollar reserves were going to be in a pickle, and so we couldn't revalue the dollar. They had to revalue against us, and so what happened was President Nixon imposed a 10% import charge that was going to be removed if and when they revalued their currencies appropriately, which is what happened. And within 18 months, the world kind of came to a bit of a equilibrium and things were going okay, and then a year later we had the oil shock Jay referred to earlier.
And so I can't resist asking the chairman of the Fed if it worked. If we hadn't had the oil shock, it was a good idea.
We were going to switch to a floating rate system eventually. Milton Friedman was right about this, and it was a good thing that we did.
Okay, yeah. So this brings us, Condi, would you hop in on the gold window?
Which person here is not like the others? I'll leave that to the economist.
All right, then the wage and price controls, again, I'll set it up. President Nixon imposes wage and price controls. Director, as he was then, director of the Office of Management and Budget, George Schultz opposes the measure, but finds himself overruled by John Connally, as Secretary of the Treasury, and Richard Nixon. In 1972, George Schultz himself becomes Secretary of the Treasury, and by January 1973, he had abolished most of the mandatory controls. He abolished the controls entirely in April 1974, just before stepping down as Secretary of the Treasury in May. So again, it is inconceivable. The notion that a president of the United States would impose wage and price control strikes me as inconceivable now. So we need this sort of reconstruction of what were they thinking. And then also, is it fair to see this this episode as a kind of the old statist view represented by John Connolly versus the new Chicago school thinking in terms of free markets represented by George Shultz? Is it as simple and straightforward as that? Mike, do you want to take a shot at this?
For many, many decades, economists have debated, and we thought we had won this battle, but it's come back several times since, the propriety of using what's called incomes policies, which were basically the government jawboning business and labor, which may have made sense in the economy where a large fraction of the labor force was unionized. Unions were very powerful. If it made sense at all, that's when it made sense. But in any event, we wound up in the situation where we had just a remarkable series of key intellectuals coming to the conclusion that we weren't really sure what we could do about inflation and unemployment occurring at the same time. We had to do something. We didn't want to inflict any pain about disinflating the economy and causing a recession. We couldn't use monetary and fiscal policy very well. And this became a big debate. And we thought it had ended successfully with the end of wage and price controls, but it came back. In fact, when I was advising candidate Reagan in 1980, the campaign asked me to debate Walter Heller, who'd been President Kennedy's chair of the Council of Economic Advisors and a key architect of the Kennedy tax cuts, on this precise point. And you had, like the head of the AFL-CIO, key industrial business leaders like the head of DuPont, Lane Kirkland and Shapiro, deciding they would decide what to do with the government in the room, kind of getting back to the point Jay made earlier. And fortunately, that didn't happen. We had a successful, if painful, disinflation. But I'll turn it back to Jay, because I know he has some views on this as well.
Yes, Jay.
So, I mean, the interesting thing to me is that, as Michael pointed out, there was almost a consensus that we needed income policy. In other words, that the government needed to jawbone companies informally, at least, let alone, and then maybe would eventually need to do wage and price control. So if you go back to 1966, George Schultz held a famous conference with another University of Chicago person, and it was on guidelines. And the big names of the era debated. Milton Friedman famously debated Bob Solow over this, but people really thought that there was a problem to solve. There was general agreement that the problem of high inflation and high unemployment, that fiscal policy wasn't going to be able to handle that, monetary policy wasn't, so you needed the government to somehow do this. This was a bad idea. It was a really bad idea, and somehow it had become approximately conventional wisdom in these days. Milton Friedman, of course, was a big exception. George Shultz was on the right side of that. Paul Volcker was on the right side of that. But to me, there's a takeaway there, which is that, our understanding of the economy is ever evolving. The economy itself is ever evolving. So I think those of us who are doing economic policy have always got to remember that the structure of the economy is always changing, and that our understanding of it is always highly uncertain. So certain things that are sometimes accepted as conventional wisdom, people will look back in 50 years and think, like we're doing with wage price controls, they're going to say, what were they thinking at the time? Well, that's what they were thinking. They were thinking it was really the beginnings of stagflation, high unemployment and high inflation. What do we do? Very difficult problem. And Paul Volcker kind of had the answer and eventually did it. George Shultz deserves credit for supporting him, and Reagan deserves credit for supporting him as well.
Yes, Connie, first.
Yeah, I was just going to say that this is also quintessentially George Shultz. So he lost the argument. But he understood who was elected, and he was able to bide his time, and then we had the opportunity. He worked to move things in the other direction. But George was, in that way, quintessentially a pragmatist always, also.
He played a long game.
He played a long game, and I think it isn't as well understood that when you're in government sometimes, you're going to win some and you're going to lose some, but if you never lose sight of what you think is right, you might have a chance to correct it. And I know that the wage and price controls, for George, this was really an anathema. And he thought one of the arguments that he was most unhappy that he lost, because he thought it did great damage. But when he had the opportunity, he reversed it.
So,
Yes, one quick comment with respect to Condi's comment about winning some, losing. We always thought we were doing well if we were above Shaq's free throw percentage. But it's important to remember what was going on in the economy, as Jay has mentioned. Nixon imposed wage and price controls when inflation got up to 4%. It's important to have that historical reference in the back of your mind.
So, thank you for the seminar. What I hadn't realized is the extent to which there was a debate going on within the discipline of economics when the shock hits, which means you don't have, I don't know how to put it, I don't want to use the word establishment, but you don't have consensus on how to respond when the oil shock hits. In the 70s, the economy is taking one blow after another, and the economists there's a debate about what should be done. There's a kind of uncertainty. Is that fair? A fair description?
Absolutely.
All right. So then we get to Ronald Reagan, and I hadn't thought of it this way before, but this is a moment when one side wins the debate, is one way of thinking about it. George Shultz, before becoming Secretary of State, which he did about a year into the administration, he chaired President Reagan's Economic Policy Advisory Group, a group that included figures such as Milton Friedman. This is Mr. Schultz in a 2000 interview talking about those times. The advisory group said the essence of the inflation problem is monetary policy, and to deal with it effectively, you've got to discipline the money supply. People warned President Reagan that if he did this, there's likely to be a recession. By the way, I was there for that bit, and people did warn him just that. Back to George Shultz, but he did the right thing, and we did have a recession, but inflation dropped like a stone, and that has been one of the primary reasons